with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, May 23rd, 2025. I want to give a shout out to Mike and Margie, Sherry and her husband. That reminds me, I have folks ask me sometimes, David, how come you only list one spouse and not the other? Well, it's because some of you have very unique name combinations, right? It'd be like saying, shout out to Ricky and Lucy, or Sonny and Cher, or Barack and Michelle. And if I did that, then everyone would know who you are. So that's why I hold back sometimes. But the spouses, we love you too. So hey, let's just jump into the numbers. Let me tell you what's going on here this week. Guess what? The market went down this week. But guess what else? That was no surprise to you because we talked about it last week. Look, we said, listen, the market looks stretched. All the indicators suggest that the market is probably poised to take a breather, probably head back down. I kind of thought it could start here towards the end of this week into next week, and it has, right? So the S&P 500 this week down 2.6% on the week. So a pretty big move there. Dow Jones Industrial Average down 2.4%. The NASDAQ Composite down 2.4%, and the Russell Small Cap Index down 3.4%. So all the major indices back down negative again this week. And then some of you are asking, hey, David, what about that new investment you bought last week, that managed futures investment that you were talking about? It was up 0.8% on the week. So pretty happy to see it doing its job and providing some diversification there, which worked out pretty nicely. But with the market taking such a big hit, as you might imagine, the volatility index took a hit as well. It was up 29% this week. The VIX up to 22 right now. So it took a big move higher. And look, that can continue. There's a lot going on right now. We'll talk about in a minute what's moving the markets. But with all these headlines, we may not be finished there with the volatility index. We may have further to go. When you take a look at the sectors, the defensives were defensive. Staples, right? Your soaps and shampoos, things you need, not things you want. They were down 0.5% this week. Everything else was down 1 to 3. Semiconductors down 3.6. Retail sales down 2.3. There were some earnings reports this week from Home Depot, Lowe's, other companies, and they just really weren't what the market was looking for. It was hoping for more, didn't get it. Looking at other things like materials down 1.5, real estate down 3.2, technology as a whole down 3.4. So everything's just looking pretty ugly. And then gold and silver, we mentioned last week, gold has been kind of in this corrective phase, this consolidation phase. And I said that, look, if the market starts to roll over, go back down again, gold will probably pick back up once more. And doggone it, that's kind of what it did this week. It was up 5.2% on the week, and silver up 3.9%. So what's moving markets? Well, a few things. The first thing that the market had to contend with coming into this week was a downgrade of U.S. debt by Moody's, the rating agency. Of course, a lot of the folks on TV are making a big deal about this. Let's talk a little bit about this. First of all, Moody's is a little bit late to the party. Right, the first one of these happened, I guess it was 2011. And before all that took place, I was actually very concerned about it. I had heard some rumblings here and there that this was a potential thing that was about to happen. And when you start talking about downgrading the safest investment in the world, United States Treasuries, you got to worry about the impacts. So we're taking the way back machine here, going all the way back to the very first debt downgrade many years ago. I called a meeting with a guy named Tom Metzold. Tom Metzold was a portfolio manager, a bond manager at Eaton Vance, one of the top bond managers in the country at the time. I scheduled dinner with him in Philadelphia, and I went and met him. And I said, look, Tom, here's what's on my mind. Here's what I need to know. If they downgrade U.S. debt, what is going to happen with the bond market and everything else? First thing he did was he dismissed me, which I found pretty irritating. Oh, that's never going to happen. Just forget about it. Not going to happen. I said, well, you know what? Humor me. Just humor me. And let's say it does happen. My question is, what are you going to do about it? What is the industry going to do about it? And what he said next was, I found pretty profound. He said, there's nothing we can do, David. He said, where are we supposed to go? There's a demand for debt. People want to buy bonds. They want to collect interest. They want safety when they do so. Who else has the paper to replace the United States? He says, nobody. We said, where am I going to go? Germany? Yeah, they're AAA rated, but how much debt can I get? I can't get that much. No one's got it. Where are we going to go? China? We're not going to go to China. We're not going to go to Southeast Asia. We want to deal with safety. And even if they downgrade U.S. debt, it's still going to be the safest game in town. Nothing's going to change, even if it happens. Well, I took those words to heart, and guess what? When they got the downgrade, that's exactly what happened. Actually, bonds went up in value, not down. Everything was fine. There's a little bit of a knee-jerk reaction, but then everything settled out. So all this stuff this week about Moody's downgrading our debt, look, if you don't know that we're in a bad spot right now financially as a country, then you're living under a rock. We've got far more debt than we can handle. We've got to get the ship corrected course. It's no surprise to anybody, but I think the media is making a bigger deal out of it than what it really is at the moment. So then the second thing that moved markets this week, and this kind of goes hand in hand, is President Trump's big, beautiful bill. It looks more like a big, expensive bill. And the market doesn't like that right now either. It looks like the bill at this point in time is not going far enough to fix our financial situation, to make an impact on the debt, to make the market feel a little bit more comfortable about where we sit right now financially as a nation. And therefore, we saw interest rates spike tremendously on this news. You would think they would have gone up on the debt downgrade. Not so much. It was the bill passing the House caused the bond market to really lose its mind earlier this week. And we saw interest rates spike up significantly. Look, the TLT, long-term bonds, down 2% on the week. And we saw 30-year bonds hit over 5% this week. This is concerning, and this is something that we're watching very, very closely. People have asked me throughout my whole career about the country, the solvency of America, about the country going bankrupt, all these different types of things. I said, look, at the end of the day, you look at debt to GDP, not the total dollar amount, whether it's 5 trillion, 7 trillion, or where we're at now at 30-some trillion dollars. You look at the percentage of debt to GDP, and we've always been in a pretty good spot until these last few years. Right now, we're the worst position we've ever been in. We're pushing close to 125% debt to GDP. The last time we did this was World War II. We were at 120%, but there's some big differences. World War II, Social Security covered one widow who was expected to be dead before they could collect. There was no Medicare. There was no CIA. There was no NASA. There weren't goose poop studies in Montana being funded by taxpayer dollars, right? We blow so much money now. We have so many obligations on top of that, that 125% debt to GDP today looks far, far, far different than it did back at World War II. So it's a problem. But as I tell people, the United States, yes, is probably living in a big straw house, but it's the biggest, strongest, baddest straw house on the block. Everybody else is in worse shape than we are. China, Europe, you name it. Nobody else holds a candle to us at the moment. So even though there's issues, the market's reacting to it, I don't see us careening over a cliff at the moment. The signs just aren't there. The bond market is something to watch, and we're watching it very closely. And then finally, the last thing that moved markets this week was President Trump himself here on Friday, out of the blue, picks on Apple, says he wants to put a 25% tariff on Apple's iPhones because they're not being made in America. He doesn't want them made not just in China. He doesn't want them made in India either. He says he wants them made in America. If they're not made in America, he's going to put a 25% tariff on Apple iPhones. Now, first of all, I really don't want to pay $3,500 for my next phone. Secondly, I'm not really sure who's going to get to do the work. We got a little bit of a situation in America. We've got a lot of folks that just don't want to work and they're getting paid not to work. So if you're going to move the jobs here, we better make sure we've got somebody to do them. And then thirdly, it's just the logistics. You just don't move a supply chain in the blink of an eye. So there's a major issue with all of that. The market didn't like it. Apple, of course, took a big hit on that news. And then in addition to that, our negotiations with Europe on tariffs have not been going quite the way that the Trump administration would like. And he threatened a 50% tariff on European imports today as well. So the market was really down and out this morning. I mean, it was getting crushed, down about 2% this morning. It did finish off the lows, down about 0.5% on the day, about 0.6%. So it recovered a little bit. I think the market's trying to parse out what's real, what's bloviating, what's posturing and what's actually on the table. I think the market's thinking that a lot of what was said today was just posturing. So all of that said, this rally that we've been in since early April finally cracked. We're finally starting to pull back from it. So now the next question is, where does it stop? Well, the first level of support that we're watching is 5,500 on the S&P, and it closed this week at 5,802. So there's a little bit of a move down from there. And then if it doesn't hold that level, the next level in line would be 5,200. And I think, look, 5,200 to 5,500, I think is a very reasonable place for this market to find some footing if we're going to go a bit lower. And I think we should go a little bit lower. It's a huge move very quickly. And what's changed? Not a whole heck of a lot except the big delay on tariffs, right? It doesn't mean that there's not going to be a higher tariff level. There clearly is. So there's still a lot of stuff this market's got to work its way through. And I think that you're also going to see an impact on next quarter's earnings as these tariffs start to trickle through and really make an impact on businesses and the overall economy. And some of that's not priced in yet. So the technical accomplishments, and I was talking to a young man earlier today about this, Landon, sharp guy. Technical accomplishments of this market since early April have been such that I'm really hard pressed to believe it's going to go all the way back down to the lows earlier in April, down to that 4,800 range. That's kind of hard to see it doing that after accomplishing as much as it has. But it doesn't mean it can't be sloppy here for a while, and that's our expectation. So look, we're in a great spot. I've got everything positioned right where I want it. I'm hoping that this downturn will give us an opportunity to add a little more to all the things we bought back in early April when things were really down and out, because there's a few stocks I would like to buy more of. So we're going to sit back, let things unfold, try to pick up some bargains if the opportunities arise. But other than that, I think we're sitting in a great spot right now. It goes up, goes down, goes sideways. I think we're in a really good position. So I'm going to go and wrap up. But between now and next few meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's sell that house and move to another state and buy another one on the water and hang out closer to your friends. Maybe it is start a new business or retire a little early. Hey, you know what your goals are. Don't just think about it. Think big. Think B-I-G. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.